For 2 days now, markets have closed on their lows, signaling that probably bears are in control. We've also got a change of trend that we need to discuss on some major timeframes. Hello, ladies and gentlemen, and welcome back to the Daily Show, where we talk about stocks, commodities, and cryptos daily. We'll be going through the hottest charts, but more importantly, we'll also bring in the data and our thoughts on earnings season so far. Many big tech companies are holding this market up, but the rest is crumbling beneath our feet. So let's talk about everything that's got to do with these charts right now. See you soon. Well, welcome back everyone to the Daily Show, where we talk about markets around the world. If it's your first time here, welcome to the community. Consider subscribing and smash that like button if you find value in today's video, which I'm sure you will, because we've got some big stuff coming your way. We'll start off here with the news and the data points, and then we'll lead into the hottest levels on the charts right now with some big moves across some of your favorite stocks, including Tesla and, of course, the major indices. Now, what's notable is Meta's big meteoric rise after hours. Now, we knew that the options market was basically telling us that this one would be one of the most volatile bits of the week, and it knocked the lights out in terms of the way the markets reacted. It was up well over 10% after hours, and it didn't look like it was fading yet. However, if it follows the trend that Microsoft and Google did, it might be a little bit too excited, and we'll talk about the key critical resistance level that it actually moved into. But good news if you were long on Meta, and congratulations for where it's going to most likely open. Let's now talk about some of the movements or rotations going on underneath the hood in the markets though. As earnings season comes through, if it wasn't for some of these big tech stocks actually holding up the market, it would be a very different picture. Here we have a disparity between basically some of the major indices, the Dow Transports Index, the Russell 2000, and the S&P 500. And you'll see that they are not the same over the last 50 sessions. When we go into the reading into this a little bit more and we start thinking about the data, what is it telling us? Well, we've brought up a lot of murky data on this show over the last couple of weeks that's showing us a lot of 50s, 45s, and 60% bullish over the next 2 to 3 months. Now, if you know your stats on markets, you know that generally markets are around 68% bullish. So when you're getting stats underneath this, it usually means it's a murky or dodgy period that you need to be ultra careful and potentially more nimble and fast than usual, unless you have massive time frames. So here are some of the reads, and you'll notice the notable one here is 2 months later, only 55% of the time is the market bullish, and 12 months later, only 65% of the time is market bullish when you get these reads. When we go a little bit deeper into the data and we think about transports and small caps, it actually gets a little bit worse. And you can see here the notable one, again, being that 2 months, showing some weakness over the short period of time here. And again, we get more reads here, weakness 1 month to 2 months into it when we pull all of this data together. So what does this mean for us as traders and investors? Well, it definitely means that we need to pay attention to these markets and understand that it might get worse before it gets better. And that's probably a reading to do with also what the Federal Reserve is going to tell us they're going to do. Will they go another 25 basis point rate hike? And what the market believes the Fed should be doing, which is many, many rate cuts by the end of the year. We still think that's going to come to a loggerheads at some point. And if the market's right, then maybe everything will be okay. But if the Fed holds its ground, I don't think the market's going to like it. Let's look at smart money versus dumb money. This is the flows that have helped us really define the fact that this was way too high at this point, and we were probably expecting a fairly poor earnings season, at least in terms of stock markets overall going down. And you can see here that smart money has just started to purchase a little bit back into these cheaper prices. Not a huge inflow, but a little turnaround as markets have returned. It's pretty normal. When you see a dip on markets, smart money tends to buy. When you see these huge rallies, especially when rallies slow, that's when the smart money tends to drop off and dumb money tends to buy in. Fear and greed markets have changed a lot over the last week. We went from a 70 plus reading on the greed index all the way back to neutrality over just a week. And this shows you, of course, how fast markets can move. But what we will be looking for over the next coming weeks is an increased level of volatility. We mentioned this in our previous video, which was the volatility of volatility is starting to rise again. And sometimes this precursors some serious problems in the VIX. And the VIX is being probably suppressed due to zero DTE options. And there's all sorts of weird things going on in 2023 that are very different from any other period of time in markets. These zero DTEs are really having a huge impact on what we're seeing moving forward, and also how the VIX is interacting with normal volatility that we should be having around these particular peak bits of news. It's kind of like it's almost being suppressed and that it's not able to jump out due to these zero DTEs. So let's talk about VIX and look at the stats here again, focusing on the 2 months, because the 2-month data, as we saw with the Russell 2000 and the Dow Transport being much weaker than the S&P, is where the murky waters lie. Only 45% of the time when we get readings like this, which we only got a few days ago, usually 2 months later, markets are actually down. It's the same thing with other markets as well. Nothing seems to be safe when we get readings like this. And I think that's the important factor. When we get the readings on this VIX, we tend never to have any safe havens other than maybe the cash components and certain bonds out there. Gold is not usually the safe haven. When we get readings like this, look at how bad the gold stats turn over the next 2 months. 36% only bullish over the next 2 weeks, and very lackluster returns over the next 2 months, usually when we get this. And it gets even worse for things like treasuries, which only 9% of the time, 1 month later, are bullish past this point. Now, of course, it improves later on, but geez, I tell you what, 9%, that's a bad stat. And what it's usually telling us is that we're going into a period of time which is more to do with a market fearing a recession again. That's usually what happens. Gold doesn't tend to hold very well when markets fear recession. It is not the recession hedge like everybody thinks it is. And you can go back and look through history, but you'll see it comes down initially with the market, then often rallies through. And gold is actually more of a currency. It's the oldest currency, and it's really susceptible to yields more than anything else. And we'll discuss that in upcoming videos. So make sure to subscribe to the channel if you're interested. We'll go through these very quickly. Breadth is nothing new. It's pretty much what we just talked about. The breadth of the 50-day, the breadth of the 200-day. We're not positive leading into this earnings season. And again, murky waters over the first 2 months. Less than the normal statistics towards bullish markets, which usually markets are. And we're generally an optimist in terms of how we're looking at these things. You have to believe over a 5, 10, 15, 20-year period, the markets are going to be bullish. You'd be almost foolish not to. And generally, you'd always be wrong. But let's now talk about earnings season a little bit more. Will we get a sell in May? Well, of course, the statistics for many years have been no, but 87% of the S&P 500 equities will actually have reported by May 5th. So this means that we have that possibility of all of that potential good news, the catalyst that will drive this market will be gone. And what's left? The reality of the situation. We know that the Fed is tapering. They're tapering again. Here's the spike of what they did during March, which of course rallied especially tech stocks. They're very susceptible to this. The taper is in. I've got our own custom chart over here on the FX Evolution community that I'll be looking at. And I can tell you it is right there still, basically at the time of this recording. I'll update this chart when necessary when we see a big move. But again, a new lower low, not really conducive with new market highs. We also know that the market is following the normal curve of what's occurring. Curve steepening, that's now stopped. We're starting to see a little bit of reversion of the yield curves across the board. We're seeing credit tightening at this stage. We're not sure how bad that's going to get, but watch out for zombie companies. They may struggle to get financing, and we're already starting to see quite a few bankruptcies coming through. And then, of course, we should see a Fed pivot coming up, maybe one more 25 basis points. Though I'm not really won over by this whole 80-90% of economists thinking there's another one. I would actually say it's a 50-50 in my book. I really don't feel strongly either way about that next 25 basis points. Then you generally get a Fed cut, and actually markets usually perform pretty badly after that. So remember, it's very normal what markets are doing right now. We've tracked it many times. Generally leading up to the pivot, markets have actually stayed high and kangarooed around. And then when the pivot occurs, that's often where you get that next drawdown in the markets. And that's because something is broken in the system. Remember, the Fed doesn't pivot because, oh, it's all great. They pivot because they need to support the economy. Now, this is a chart that we've brought up many times. Lagging Fed hike impacts have been exacerbated by the tighter credit conditions from Silicon Valley Bank. This is good news if you're a bear because it's brought forward the problems. Before we thought, oh, maybe we'll have to wait till 2024. It's now very likely in 2023 we'll see some cracks appearing in the economy and therefore maybe something we can take advantage of. I also want to bring us just to this chart again. I talk about it all the time, but it's got to do with the biggest money in the world. You know, I'm always a big believer of following the big funds to a degree. And what that means is that if they're moving into something such as money market funds, while they're continuing to move into that, I don't really feel comfortable saying that a bottom is in. Generally, they will float back around and then get back into the asset. They're not in the business of losing money, and technically they do a pretty good job. And of course, we saw in 2020, they did the same thing. They went quickly into money markets. And look, they actually were smart. They were going into money markets before. See, this is when you actually got the inversion in the markets of yields. And look what they did. They went in pretty hard. And then straight away, they converted back into the market, or at least started pulling some of the money out. It's that conversion we're looking for. When that declines, well, we need to be paying a lot of attention to the other reasons in the market. So we have the 14th best earnings season run up in history. No wonder we're probably falling back a little bit. Basically, the market's preempted. They did the buy the rumor. Now it's possibly sell the fact. Yes, I know they're not selling the tech stocks that we all love out there, but they are selling many other stocks that are actually coming out with earnings. And things like KRE, which is, of course, the regional banks, that's actually not doing very well at all, which we might look at later. Now, when we get these really good returns into Q1, that is, markets go a little bit haywire and hectic into it, it's not, again, a very good 2 months later. And I just want to focus on the 2 months here because most of these reads are showing us 2-month issues. Over here, we go to the further earnings calls we have this week, and it doesn't really stop. We've got big ones coming, Amazon and Intel notably. These are two of the most volatile, and Meta was even wrong by the options market. Meta was expected to be somewhere in the vicinity of 8% move. It ended up being like 10 or 11%. And you can see here that we still think Amazon and Intel, according to the options market, is going to be a very volatile period. So Amazon's going to show us a lot about consumer demand, and I think that will lead into Apple's price a lot. I wouldn't be surprised at all to see Apple react more than it has done so far off Amazon's earnings. So we'll have to find out whether that occurs, and that's less than 24 hours away now. So it's all happening, and you are very close to basically the beginning of the end for these biggest tech companies. You know, how much more can they run and support this market? The thing is, Microsoft's up like 7-8%. Meta's up 11%. Google's kind of done its thing. Amazon's already running into this announcement. And then Apple, of course, is hovering around. Those stocks are already moved pretty heavily, and the markets are still down. So what is really going to support this market other than a deep recovery through the whole breadth of the market overall? Let's look at what the biggest players have been doing. The last 5 days, we reported on this before the sell. We knew they were moving defensive. Staples, healthcare, utilities. They're the best performers still over the last 5 days. Poor regional banks down here, down 7.11%. We'll look at that chart later on. Let's move over here to what's happened in the last 24 hours. Well, technology is holding the market at this point. Of course, we see a little bit of supply, a little bit of recovery here in the regional banks, but it wasn't the day of defensives. Healthcare and utilities had a horrible session in comparison. So is this the switch? Are they making a little bit of a move up? We'll talk about that when we look at the charts in just a few moments. So just before we jump into the charts and we take a look at all of the hottest levels that are happening right now, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, if you've been watching this channel for a while, you would know that Microsoft is my favorite stock. So I've managed to work with Tiger Brokers on a couple of additional extras for our Australian viewers out there. Don't worry, there are other special offers down below for other members around the world, of course, but I did manage to get some additional fractional Microsoft stocks. So if you're interested in getting on board that train, then you can see here that if you fund, you get as little as 1 cent, you get US dollars, $25 worth of Microsoft fractional shares. But for a little limited time, if you fund with as little as Australian $1,500, you'll get an additional US $30 worth of Microsoft shares. But it doesn't just stop there. As we enter into not only earnings season, which we'll talk about with the platform soon, we're also entering into the end of financial year here in Australia. So, of course, this means it's tax time. Yay. So what do we need to do with tax time? We need to produce reports. And of course, Tiger Brokers have realistically gone and found one of the best. And there's a special offer out there for Tiger Brokers members if you sign up before the 30th of April. Basically, if you sign up before the 30th of April, you can attach your Tiger Brokers platform to the ShareSite platform, allowing your taxation to be even easier than ever before and tracking of your portfolios. And I believe you'll get 1 month free trial. And then, of course, you'll also be able to set it up with a special $99 per annum fee. And I believe that's for both the Australian and the New Zealand audience out there. So what are you waiting for? You might as well check that out right now, especially if you're an Australian viewer. But we mentioned earnings. Now, it's not just earnings in the US that we're waiting for. Australia's coming up and other countries are also coming through. But you want to have an earnings calendar that realistically goes with all of the information. Luckily, Tiger Brokers platforms offer this, and they also offer what I like to do, which is watch earnings calls. Sometimes it's a little bit annoying to find the earnings calls. You can see here we've got Meta's earnings call right now inside the platform, which we could be viewing. We've got Amazon's earnings call coming up, and of course we've had Google and Microsoft's earnings calls later or earlier this week. But you really need to have an investment calendar. You need to have the ability to view it daily, weekly, monthly. And probably my favorite new feature they've added is quick live premium news. And what that means is that it refreshes every 1 minute. You get instant gratification, I guess you could say, with all this amount of information that's coming through. And it's very, very good to have. You know, it's kind of like having a mini terminal in some ways with the constant amount of information that's being thrown your way. If you're interested in Tiger Brokers and all of their special offers down below, check them out. And especially for the Australian viewers, if you want to take advantage of the maximum amount, remember the $1,500, the extra Microsoft stock. And if you sign up before the 30th of April, you'll get that special 1 month free as well when you link it to the ShareSite platform. So give it a shot. Thanks so much. All right, well, let's jump into the charts and we'll start off here with the VIX. So as we mentioned, the VIX is being suppressed right now by 0 DTEs. So basically these new one-day expiry options are suppressing this thing. We mentioned that this was our catalyst. I really felt strongly about this level. The lowest VIX level since this whole crisis began was reached only a few days ago. Since then, VIX has been going up, and I think the VIX calls are skyrocketing at this stage, and they're literally being suppressed by the 0 TCEs. So if we have time, we'll do that in our next video where we talk about that a little bit more in detail, because it's a very interesting point. It's so different from the dynamics that we've had over the last couple of years. This is a new learning curve, and this is when you have to be market adaptive. You have to start learning new things and potentially focusing on slightly different indicators. You know, the VIX might be totally pointless in the future to even watch. And that's why the CBOE has actually put out a one-day VIX as well. So we'll look at that code moving forward, because that's going to be a big thing here on the channel. And I believe it's going to be something that all of us, traders, investors, we're all going to have to start focusing on that one as well. Let's look at the breadth. 98% of the Russell 3000. That's 98% of all of the stocks pretty much in the US market. Breadth just keeps getting worse. That is not a good sign for markets. And of course, it shows us the weakness across the board. Treasuries didn't have a good session. That's partially, well, it's probably just because Treasury didn't have a good session, really. The yields went up a little bit, US 10-year notably. However, yeah, we're looking for the same thing. We want US 10-year to drop through 3.3, and that should push Treasuries through the high. Though we saw some stats in today's video that really point towards Treasuries having a little bit more of a tough time. I'm still bullish Treasuries. I don't really have too much problems with the stats that we've seen. But yeah, this was the island reversal we mentioned the other day. So far, so good. Still really nice returns. Way better than the stock market at this stage. And we'll have to find out whether it can hold up a good session moving forward. High yield bonds were down on the session with the stock market. That's a good sign, though I would like high yield bonds to drop further. Basically, these junk bonds, you want to see them coming with the stock market. If the market's driving lower, you need junk to go with it. That is the ideal. US 2-year was flat. US 10-year, as you can see here, was up slightly on the session. We're looking for US 10-year through this low if you're a Treasuries buyer. But Treasuries will have a lot of anxiety on them moving forward. And the reason is going to be as simple as this debt ceiling. I'm not really too concerned about it. However, the market may react that way. This is the big one that I think too many people are underestimating, and that's got to be copper. Copper is going into a period of weakness, so it's usual to see it find weakness here. But I still think copper is a big driver of the world's economy. And if copper price falls off heavily, we've already done some analysis here on the channel to show you that the SPX, the S&P 500, doesn't like it. So if markets fall through here, it usually means demand destruction is well underway. We probably go to this level, we keep going down. And once that's occurring, oil's going to do poorly. Generally, you're not going to see very strong movements out of any of the metals. So metals become a very good short. And copper is testing the lows at the time of this recording. The good old US dollar. Now, this one is sneaky and a little nasty. If you had stop losses under here with the, the pullback, and I think it was, we didn't end up getting the 2-hour close high, but if we had a 2-hour close high, I said this to the private community, I was looking for this to actually go long. Stop losses that are conservative be under here. This, of course, would be a tight one. And it's still in a downtrend overall, but I would like to see the dollar stabilize here. And you can see at the time of this recording where it's at and where it's sitting. It did end up getting a wick up, which is good. Maybe that was a bit of a hunt, but I don't really have too many strong opinions on the dollar. Where we went to in gold, though, is a little bit more interesting. So gold came and it tapped our heavily traded zone. Now, we've shorted this a few times, and you can see it went a high and a low and a higher high, and now it's made that lower low. So I kind of like in this red box here for the potential of day traders and scalpers to find opportunities towards the short. I'm hoping that will happen again. It's becoming a little obvious, which is not something I particularly like, but we keep putting tests on this trend line. So if we have a look at this trend line here, we've tested it, and we're not making a series of higher highs. We're instead basically just coming down, testing it, barely bouncing up, and then floating around. And if you look at the daily here, I think it looks more weak than strong, and that's consistent with some of the data stats we've seen. So I'd like it to get back in that red box and hopefully find some shorters. Let's move over to natural gas, and this one here is still going into our red box. Nothing much to report there. Oil had a really bad session, so we certainly switched negative on this. It changed trend, and this actually is very similar to the market. So where the stock market is at. So we've basically got this daily candle that closed near its lows here. Then it came down, it consolidated, and it keeps selling. Where does oil stop? Well, I don't really have any strong opinions on oil trades right now. I don't actually want to do any trades on it. If we have a look over at the energy stocks, you can see here, now this one I feel a little bit more towards the negative side because energy stocks have held very, very well through these oil prices. And you can see that this actually looks a little bit like an island reversal. It opens here, which is a gap below. So we have a gap up, we have a big structure, and then we have a gap down. So is this the beginning of weakness for the energy market? It didn't close on its lows, which is a little disappointing, but I do think that this is a big turn point for it. So for me, it's more energy stocks are weak than necessarily liking the short on oil at this stage. We'll move over to one of your favorites. I know the community here likes Tesla, at least in terms of day trade. We're below the expected weekly options low, but I kind of expected that this week. I don't even know why these were so tight, considering all of the earnings reports we had. But either or, that's another bad daily close. There's nothing to like about Tesla. It seems like it wants to go for the gap fill. We've mentioned this for a long time. I just can't see anything here that's positive at this stage. And at 153.75, it's in the middle of nowhere land. So you'd think that rallies are probably going to be met by sell demand. We reported on the previous session looking absolutely horrendous and 4.31% down again. So I think that the main points that this market's going to go to, I wouldn't be surprised to see some buyers in here. And I also think there's a potential return all the way down at the 120s. Demand destruction's in play. You can start to see that with copper. You can start to see that with oil. You can start to see that with yields and where they're going. And that's not great for car manufacturers. And of course, yes, Tesla's more than that, but it also has a high valuation. So it's a bad close, 2-hour charts, nothing much to like. I won't like this stock in terms of buy zones until we get above that white line there. So in this case, it's just still weakness. Sorry, guys. That's how it is. If you're on short, then you're probably happy with that. Let's have a look ahead at Amazon. What's it doing? Well, it's just floating around. Now, this could be considered an island reversal as well because we have a gap up and we have a gap down. It's come back to test that. And then we have a gap down, a gap up. So it's confused. And that's because it's earnings season. Yay. So whenever we have earnings season, we usually find stocks at big levels. If Amazon has a really nice blowout report, then it's most likely going to open at one of these two levels, which would be percentage-wise, you'd be looking at either 7%, which seems like the more likely one, so that 113, or that 120. So remember, the good thing about earnings season is that you're pretty sure when stocks tend to have good or bad earnings, they gravitate heavily towards the next critical level. And I'll show you that with Meta in just a second. So you can actually put spreads on these levels. And if you know anything about options, you'll kind of start to figure out why that could be an interesting concept and actually could pay pretty good ratios. So spreads are the key often to these earnings calls and looking for those next resistance or supports. So from the downside, you would probably think that Amazon would go somewhere around 9.7, which actually would work, 97, I mean, which actually would work out pretty well to its percentages. Now let's have a look at Meta just to exemplify that concept. And then we might load up Microsoft just so you can see it. Where's the next resistance or supply? Here. Where did the market end up? Well, I think we all know that's where the market was after the earnings call. So yeah, effectively it's gone back, it's gone to the next level. And this is where you expect it to actually fade. You know, a lot of people buy in and they go, yeah, YOLO, let's go. That's not usually the best technique if it's already run with a huge gap and everyone's hyped on it. You look here at my favorite stock, Microsoft. Where did it go? Well, it went up in here into 300s. And you can see there's a little bit of structure in there. It filled a gap that it never had done. So that fill gap had completed. And yeah, it then faded a bit through the session. If we go over to a stock like Google, it didn't actually get up to those highs. But these are the types of things that you're looking at here. I mean, NVIDIA could be in distribution at the moment as well. We're stuck in a tight range. Apple, again, most important trend line pretty much on the weekly here for this entire crash so far. Apple's had some amazing runs back up to this trend line, and we find it sitting there ahead of Amazon earnings and, of course, ahead of its own earnings next week. So it's broken towards the low side here. But, you know, if Apple broke out and had a ballistic session, where could it go? Well, certainly this 171 makes sense, or even these highs 176. So remember to use technicals a little bit with earnings. Even if you're a fundamentals kind of person, you can probably see the advantages of recognizing these critical zones. Markets often just go bang straight into them, and it can provide opportunities if you know what you're doing. Let's move over to the indices now. We'll start with the Australian market just quickly for the Australian viewers out there. XJO fell through. This is expected. Copper's weak. I don't like it when copper's weak. I don't even like the Australian market when copper's weak. It's just bad. And if that continues, then I expect the Australian market to weaken off. Next target will be around the 7200, 7220 from the technical perspective. And I think rallies are met by sell demand at this stage, especially if copper falls below that low. I'd set alerts there. I'm not confident on that market. Let's move over to RSP. This is the S&P 500 equal weight. It's not good. Look at that. That's a full change of trend. We've got a high, we've got a low, we've got a higher high, and we have a lower low. So you think that rallies right now are going to be met by sell demand. Basically, the bears have regained some control. Now, you could make a case that there's buyers here on the RSP. You can see where it's got to. Big sell-off, couple of gaps. Maybe there's time for rallies, but I think rallies will be met by sell demand almost across all of these markets right now based on the evidence at hand. So let's look at the evidence together. First up, IWM, Russell 2000. Is this an island reversal? A gap up, a gap down, a beautiful island. Usually they're fairly explosive. So far, pretty explosive. You can see here the Russell 2000 is falling heavily. Now, if you know anything about the Russell, you would know it's filled with regional banks. And when we take a look at the regional bank market, take a look at this. Not enough people are probably discussing this. Regional banks fell to a new low. So that means that all of a sudden, unless this is a false break to the downside, which, by the way, that daily candle doesn't really look like that. So that daily candle looks bad, looks like a rejection candle. If we put that in perspective, that could mean that regional banking is actually even more hurt than we think, and it going lower. So I think that this is a very interesting session. New lows from the previous day probably open up regional banking and cracks to further appear in this market. And I think it's worthwhile having this on your chart, although you don't want to trade it. It just shows you why you generally don't buy absolute collapses. When markets do this type of thing, when they fall and it isn't let's say tech, the statistics of them actually coming back quickly is very bad. So when something falls like 20% in only a couple of sessions, it is not a good statistic to buy into those markets. And we know that banking sector is often one that takes a while to recover. Just take a look at 2020. It was not the first one to come through. In fact, if you were buying in October and November, which was well past all of the tech stocks and everything, you got exceptional returns from the banking sector, but it's all about timing. And at this stage, we're not seeing the evidence to show us a turn. But I'm very interested on how this trades down here. Russell 2000 futures, we're looking for closes underneath 1700 to show us full bear control. Again, it's come up. It's rejected these wicks we talked about a lot. It's shorted heavily. There's no buying that's come in yet. I would suspect that if we do get rallies, somewhere around that 1750 is probably where shorters will recommence if they're going to, because it is a fairly heavily traded zone. And you can see here, I did this up for, well, it's actually one that happened in the last 24 hours. I did this up for my private community. If you're interested, jump over to www.fxevolution.com. and you can join over there. But basically, we were talking about if it came back into this supply zone, most likely there were shorters there. And turns out there was for the session. So basically, this is still a very tough zone for the Russell. Let's move over to the Qs. These are the only markets holding up right now. Here's the Qs. You can see, again, it technically has turned. And yes, there was actually a short off here. And there's some weakness here on the Qs, but it's nowhere near as weak as the other markets. You can see here on the actual futures market that it's just holding that low. But I don't take much solace in the Qs or the NASDAQ, because I'm always looking at the S&P 500. So the S&P 500, here's the SPY. It's made a new low and it closed near its lows. Let's go over to the SPX. So we can now start tapping off a couple of these gaps. I said it was unusual here on the channel, and we talked about this together, to have 4 gaps. I can't even remember the last time we had 4 such close gaps. Well, 2 of them are now gone, and markets have now gone high, low, higher, high, lower, low, and basically we've got a switch of trend on the day. So if you're looking at this from a pure technical market, bears are in control. Rallies should be shorted. And this is the first time we can say this in a while, because it's actually a change of trend. So we've actually got what you would be looking for if you were a bear. And now I wouldn't be surprised at all to see rallies. But yeah, I mean, it's theoretically now more bear control than bull control through this earnings report. We still have 2 unfilled gaps below. We still know the 4K level is massively traded zone, so probably buyers will commence around there. But let's have a look at the futures market to get a bit more of an idea. So here's the futures market. Again, I can remove some of these things. I just want to show you what I'm doing each day. We're through these lows, and this basically brings up the ability for us now to say, okay, well, where are the shorters going to be? Where could the markets get back to? Are there going to be bulls that come in here? All sorts of things. And I think that, there's a lot of cases to be said that in here, there's going to be shorters around that 41.20 in particular. That was a heavily traded zone. That if we do end up finding rallies through 40.94, at least temporarily, you're probably going to be bullish. So 40.94 is going to be a big one to have on your charts. And because the daily closed on the lows, usually that means there's more coming in the next session. Now, that's what happened in last session. It doesn't have to, but statistically, let's call it like a 60-40 split. You usually see follow through on the next session. Whether that's a huge follow through or just a little bit, that's what we're looking for. And the obvious levels are, of course, 40.27 and 39.69. They're usually the 2 levels that you'd be looking for. So it doesn't mean that the bears are going to take a hiatus yet. The evidence states, though, that the bears have now taken at least initial control of this market. We'll look at the options market on the weekend and take a look at that. We'll look at the survey reports. And of course, we'll bring in all of our analysis together. But yeah, this is a major trend change. It's a pretty big deal. And unless it's able to instantly switch it back, I just think that the bears have taken this market for now, and at least they'll be looking at trying to sell it off. So if you've been waiting for that and you're like, thank goodness I shorted up here or whatever, well, at least you can take some solace in at least that being the potential market moves for now. This is where shorters will be. As we said, if we get through here, you're probably looking at buyers. And I think big shorters will sit around that 41.20 zone. It's a lot of stacked supply in there, which we now know is supply because the market's sold off. Let's move over now to the weird market of Bitcoin. So we reported that we thought this would rally. And it did. And it actually rallied into zones that I suspected it may. In here, 29.2 all the way up to, I actually wanted to go higher. I actually wanted to go to about 30,300. These were the levels that I would have wanted Bitcoin to go to. Now, it went here and nothing turned. So you couldn't really short that level effectively. Then it went up higher. And if we go over the whole thing, it actually went to a 75 fib retracement. Now, I would have liked it to go a little bit deeper and go into here and then show us the turn. But this has been a very volatile pair. I mean, it actually sold off massively all the way back down, then got buyers through this beautiful level, and then came back up. We don't have a switch trend that I usually would like to trade with replication, but if I was guessing, I'd probably go bearish over bullish here based on the stock market really more than anything else. And yeah, also based on these big wicks. And we know wicks hold orders, so it's not really great what you're seeing here, especially if the daily closes below like that. So maybe the next Bitcoin 24 hours will be very interesting. It's been one of the best charts, and I don't often say that about crypto, but crypto's been pretty damn good for trading over the last week. I was super happy with this level. Obviously, I did do a bit of celebration on that one, but because we waited so damn long for it. At this point, there's no significant changes on the daily, so we're looking for 26.6 to theoretically be broken before bears take full control of the crypto market, at least from the technical perspective. And I don't really have a super strong opinion on it now. The last 24 hours, I was pretty comfortable with bull. I thought it would bull more likely than not into this level. It did, went a little bit further. The way it shorted and then bought back up, though, shows me a rational market, and I'm not really super interested in trading that generally. If you are, then of course, you're all over these levels, I'm sure. Let's talk about the other parts that aren't earnings reports moving forward. Of course, we do have here a whole bunch of news. We've got the GDP and unemployment claims on Thursday, April 27th. And then as we scroll through here, we have the core PCE price index coming out on Friday, 8:30 a.m. New York time. Be sure to be on top of all the news and, of course, the earnings season reports, which really end next week in terms of the major big ones. If you're also interested in following some of our other work, you can do so by clicking on the links in the description down below. Obviously, we also have a couple of free trading cheat sheets. We also have a Twitter, Discord, all sorts of things going on that you can come and visit our community. And do remember as well, the extra special offer, especially for the Australian viewers out there. If you like Microsoft, if you want some special offers, then why not check them out? Links in the description down below. And remember, if you sign up before the 30th of April and get it all funded and things, you'll also have that ability to take advantage of the share site offer. So that's a good one as well if you're Australian and taxes coming up. Thanks so much, everybody. Bye for now.